Many of you guys enjoy my videos when I talk about the biggest mistakes stock market investors make. And whenever I do a lot of educational content, and now we're in 2025, a lot of investors are up a lot this year. Everyone, including myself, we're showing year-to-date return and investing looks easy. But I believe this is a time for me to be a little bit more transparent and talk with you guys about my three largest mistakes so far in 2025. Those were three stocks that I bought. Some of them I talked about them on YouTube. Some of them I never talked about them on YouTube. And actually some of them are looking really good right now as good opportunities. But those are stocks that just didn't work out. I lost money on them. They didn't work out. I took the loss and I moved on. And I learned a lesson. And this is how we improve as investors. We analyze our wins and we also analyze our losses. And we try to learn of what did we do right? What did we do wrong? How could this have been better? And I learned some lessons in 2025, and I learn lessons every single year. So in this one, I'm going to talk about those three stocks, why I made these mistakes, what was my mistake, why I lost money on them, and what you could learn from it so you could maybe save your own money and, maybe commit the same mistakes I made. And I'm going to share a lot of insights which you've maybe never heard somewhere else. And I'm still not feeling too well, so you have to excuse my voice, but I've been getting better over time. And I really hope you enjoy it as always. If you do, all I'm asking is press the like button and let me know what you think in the comments. Okay, now the first loss, and this is by far my biggest loss, and I'm not going to spend too much time on it because most of you guys know, is United Health. United Health, I still own the stock. I bought it at $420. Now it's sitting at $244 per share. So from $420, I'm down about 41% on this position. I'm still up, 31% on the year in total, but I'm still down 41% on United Health. I never bought the dip. I just bought one time at 420, and that was it. Now, the mistake I really made was United Health. It was cheap, it was undervalued. But if I'm being honest with myself, the mistake I made was United Health, as I didn't really stick within my circle of competence. And this is something that Warren Buffett says, which is that you should stick within things that you don't understand. You don't have to jump over 10-foot bars. You just have to step over 2-foot bars that you could jump over. This is what he said. So you have to invest in things you know, and you have to avoid what you don't know, or most importantly, what you think you know, but you actually don't know. And with United Health, I thought I knew United Health well. I thought I understood insurance, but I know I didn't for sure understand insurance. I never bought an insurance stock before. United Health was my first one. And I had a goal in 2025 to expand my circle of competence, learn new sectors, learn new industries. And I was studying insurance, and I put a lot of research in UNH, and I thought that I could potentially understand it. But the truth is, United Health was outside my circle of competence, as most insurance companies were. That's why I never invested in them. And once I got outside my circle of competence, this is when I lost money. Now, maybe that was not the best lesson to learn from UNH, but a lot of the events that came after with the CEO resigning and all of that, all of those things were unpredictable. No one really predicted them. But the truth is, if I stuck within my circle of competence with things that I understand, and I remove those things that I don't understand, like insurance, which I don't understand very well. Banking, I avoid banking stocks. Biotech, I avoid them. Most semiconductor stocks, especially small caps, I do invest AMD, Nvidia, but the small, mid-cap kind of semiconductors, I avoid them. A lot of pharmaceutical stocks, small caps, I avoid them. So there's a lot of things that I don't understand. And if you skip what you don't understand and you stick with what you really know and not what you think you know, this is a very valuable lesson. And if I have done that, I would have saved about 44% on United Health. And my return this year would be maybe 35, 36% so far. So that was a lesson. I learned it. And next time, I'm not going to get enticed because something looks cheap, because something looks undervalued. I'm going to make sure 1,000% that I understand the sectors, the industries, the business model. And if I don't care how cheap it is, I'm going to skip it. And this is what I should have done with United Healthcare. Now, this is another stock which I've never shared on YouTube. And most of you guys don't even know the company exists, but it's a very interesting company, and many of you might be potentially interested in the stock. This company is called Walmart de Mexico. So Walmart of Mexico. Just like we have Walmart in the United States, this is Walmart of Mexico, of Central America, and they have so many different stores. The stock has gone nowhere over the last 5 years. This one, I believe, I took a 6% loss on Walmex. And it's actually up a little bit since I sold it. It's up like 9% since I sold the stock. But I bought it in like January, and I sold it in March or April. So I took a 6% loss on Walmart of Mexico. Now, Walmart of Mexico is a very interesting one because 71% of the company is owned by InnerSalt entity, and the InnerSalt entity is owned by Walmart. So 71% of Walmex, which is Walmart of Mexico, is owned by Walmart. So Walmart owns 71%. The parent company is backing it. This is pretty amazing for Walmart of Mexico. The company has 3,171 stores in Mexico, 6 million daily customers. They have like 928 stores, I believe, in Central America, and they have just crazy scale. I mean, they have a monopoly in Mexico and in Central America. And over there, you have much higher sales growth than the United States. You have better demographics, better birth rates than the United States, better population growth. So all those things were helping Walmex grow much faster than Walmart over the previous years. Now, total store sales is still growing 6%. So the company is facing massive same-store sales growth in Mexico and also in Central America. Now, if you look at the multiple is really something special. And if you look at the blue, which is Walmex, Walmart of Mexico, it was always trading at a premium to Walmart because there was much higher growth in Central America. There's still more growth in Central America. Very recently, this has changed, and now the multiple has diverged where Walmex is trading at 17 times earnings, and Walmart United States is trading at 38 times earnings. So that was one of the reasons why I bought Walmart of Mexico, and this is one reason why I still believe it's attractive, but there's a trap with Walmart of Mexico, which I fell into, and I'm going to talk about this. And it's not just Walmex, but it's most of the foreign stocks. And it's a common trap that you have to think about before you buy a stock outside the United States. And I'm going to tell you this trap. But for Walmex, you also get a dividend. The dividend is around 3%. It was like 4% when I bought it. I don't know what happened. Maybe they cut the dividend or something. I don't really know. But for some reason, this chart is showing 3%, maybe due to currency problems. But the biggest trap with Walmex is shares outstanding. Shares outstanding have pretty much been the same since 2016. Now, you might say, what is wrong with that? If the company is paying the dividend, shares outstanding are not going up. Why is this a trap? Well, we tend to apply the United States mentality, North America mentality, which has a lot of liquidity, has a lot of exposure. When we try to apply this mentality to stocks in Brazil, to stocks in Mexico, to stocks in Colombia, to stocks in Africa, which I invested in all those markets, by the way. I used to invest in a lot of those markets. And the biggest thing is that in most of those countries, you actually need a catalyst for the stock to move. So yes, the multiple versus Walmart is way down. But this is due to some things happening in Mexico. Maybe they don't like the new president. Since she came in, the stock went down a lot. A lot of the Mexican stocks actually went down, and it has to do with different things. But normally, generally speaking, a stock in Brazil being cheap is not a catalyst for the stock to move up, okay? And it's the same thing in Mexico. It's the same thing in Colombia. Sometimes they do move up. But the stock, there's no floor. Just like Alibaba, could go 5 times earnings, 6 times earnings. There's no floor on that. So whenever you're buying a foreign stock, you have to make sure that they do a lot of buybacks, which is highly unlikely for you to find in a lot of the foreign stocks because they love doing the dividends. And Walmart, they can't really do buybacks because 71% is owned by Walmart of Mexico. So there's only 21 million left outstanding, and they don't have enough flexibility to do buybacks, so they only do dividends. Now, if the stock is going down, and imagine what kind of shareholder value Walmart could create at 17 times, but because they're 71% owned by Walmart, and they love paying dividends, they can't can't really do any buybacks. So this is the biggest trap with the foreign stocks, is you could buy them and they're cheap, but they can stay cheap for 5 years. There's no floor on how cheap they are until one investor or someone like David Tepper goes on CNBC and says, go buy China. This is what you need for people to buy those stocks. So you have to have a catalyst, maybe a new presidency or something, but valuation enough is not a catalyst. And the best way to make money on those stocks is to find a foreign stock that's doing a lot of buybacks. And this is how you could potentially avoid this trap. Now, the last ones that I bought, and I took a tiny loss on this one. I talked about it on YouTube before, so I'm going to give you a quick update, is Murphy's USA. I bought Murphy's USA at $420 per share, and I sold it around $415. So it's like 5 or 7% higher from here. And maybe some of you did own it, or I don't know what you did with the stock, but I gave it to you guys as an idea. I give you guys ideas on YouTube, and I gave you Murphy's USA as an idea. And I actually believe the stock right now is looking interesting, but I made also a mistake with Murphy's USA, and I'm going to tell you what this mistake is. But to give you a quick overview, Murphy's USA, they own convenience stores, gas stations in the United States in over 27 states. They have 2 million customers. Now, what sets them apart is that all of their stores, they're mainly focused on lower income areas. Because they're focused on lower income areas, they have very low EV penetration. A lot of those people, they unfortunately cannot afford to buy an expensive EV. There's no EV infrastructure in the United States, and now we don't have EVs tax credits. So the EV penetration is not going to kill Musa in those areas the same way it's going to kill ATD in Europe, for example. So they're shielded from the trend of electric vehicles, but they also shielded from the trend in declining nicotine sales, because nicotine sales are declining, and this is a high margin business for convenience stores. But for Musa, because they're in the lower income areas, a lot of those people, they smoke or they buy other kind of products, vapes and other things. And this actually has been helping Musa increase share into nicotine. They haven't been decreasing in share, they have been increasing in share. So they're also shielded from that, but they also own 75% of their real estate. They own their real estate, which means they don't pay any rent. Other companies like ATD, they don't own it. They lease the stores and they get hit by rent escalators. Musa owns their real estate. So all their real estate is owned. It's beautiful. And 70% of this real estate is located near a Walmart. And it's a very strategic location, most of them near a Walmart. And they also have a Walmart partnership. Okay. Now the company has very old stores. Most of them are like kiosks where you could like open the window and go in. It's a tiny store. And they've been doing two things to drive growth. The first one, they've been opening new stores, which are 1,400 square foot stores. The second thing they've been doing is they've been shutting down the kiosks and they've been renovating them into larger stores. And you could see the difference where the kiosk and the 1,400, they got much higher fuel gallons, much higher merchandise sales, and it's just much higher business in general. So this is helping them grow. But now it's hurting their business because they're shutting down 30 to 50 stores per year for them to renovate them, and it's killing their sales growth. So this is one reason why the stock has been struggling, and it's temporary. Now, if you look at the company, they actually are proud that their stock price has made pretty much a higher high every single year. And I talked about this on the investors presentation, where they are like the only company after Costco that has made like a higher high since going public in 2013. So this is something that they track, and it's pretty amazing. Now looking at the company, net income barely grew in Q1, but this is because of massive depreciation expense. You have to remember that the company owns their own real estate, so they have high depreciation. So if you adjust for depreciation, their EBITDA was around 286 million, which was higher than 278. So they had some growth, 1%, 2%, 3%. This is not a high growth company, and this is not the main thesis. The main thesis is for them to drive some growth, but to also buy back a ton of stock for them to create per share value for shareholders over the long term. And since 2014, they had 46 million shares. Now they have 20 million. So they bought back more than 55% of total shares. And they took earnings per share from $4.80 to $24.50. So they did not only take shares outstanding down, but they also drove earnings per share much, much higher. and it's really beautiful. Now, if you look at the company's guidance, they're guiding 1.3 billion of EBITDA for 2028, 17 million shares outstanding. They want to buy back more stock, 1 million shares per year to 17 million, and 10 to 12 times multiple. Now, very recently, the stock has gone down because they lowered their EBITDA target from 1.3 billion to 1.2 billion. But now the company is buying back more stock, much more than 1 million a year. It's around 1.2 to 1.4 million annualized. So shares outstanding will likely end up being around 15 million shares outstanding, and they expect 10 to 12 times enterprise value to EBITDA multiple. Okay. Now, for my valuation model on Musa, and I'm gonna try. This is how, by the way, how much they've been buying back every quarter. Now they're at 19.5. So they're very close to 17 million, and we're nowhere close to 2028, which means they will potentially take it down to 15 million. Okay. Now, the way I would value Musa is very simple. I would take the 1.2 billion, which is the latest guidance, and I would time it by 9 times market cap to enterprise value, market cap to EBITDA. Because let's assume enterprise value to EBITDA was around 11, 12 times, which I believe would be fair. I think market cap to EBITDA should be around 9 times. It's hard to estimate the debt, so with market cap, we take 9 times. So timing it by 9 times, which I believe is fair, this $10.8 billion market cap, dividing it by 15 million shares, which I believe is possible, we're getting $720 per share. The current price is $377 per share, which is almost 100% on the upside over the next 3 years with a company like Musa. Now, you may ask, what was the mistake you made with Musa? Well, the mistake I made with Musa is it is an amazing company. And when I was buying Musa, I was mainly looking to diversify my portfolio into a stock that does a lot of buybacks. So I wanted a stock in my portfolio that just keeps buying back stock and it would kind of hold up better in a market crash. And I wanted to find that stock. Now, I bought Musa, it was, I believe, in February. Okay. Now, I bought it mainly because it was cheap and I liked the story. But the truth is, if I paid a little bit more attention to quality, I could have paid up and I could have bought AutoZone for pretty much the same price where Musa was trading at. And that was back in February of 2025. And from February of 2025, AutoZone is up 19%. So the mistake I made with Musa is I bought it because it was cheap, while I could have bought the best buyback stock in the world. They just keep doing buybacks is AutoZone. They've been doing it for 20 years. It's the best stock of all time. But I skipped AutoZone because I believed the stock was expensive. Now, I eventually got the chance to get back in, and I bought it at 3,400 on June 25th. And I shared what I do in my own group, which is here if you're interested. But the mistake I made is I sacrificed quality because something is cheap. And most of the time when I do that, I lose money. So most of the time, it's much better to pay up for quality than buying something just because it's cheap. Always try to buy the best stock in the best industry, not buy the second or third best because it's cheaper and the multiple is low. This is how most of the value traps look like. I don't believe Musa is a value trap. I think Musa will likely do extremely well, and I might even get back in the company, to be honest. It's looking very good. But I honestly could have saved all this time, and I would have bought AutoZone at the same price, or at 3,400. Now it's at 4,000, at the same time when I bought Murphy's USA at 420. So if I did that, I would have been much better off, saved a lot of drama, saved a lot of things. And that was a mistake I made. The second one was with Walmart of Mexico, and I was mainly not looking at buybacks with foreign stocks, which is important. The first one was not sticking with my circle of competence, and I always lose money. So I hope you learned something today. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.